Hey everybody, welcome. I am Alex Jenkins with Nest Eggs. I am a certified plan fiduciary advisor as well as a Series 65 registered investment advisor representative for Nest Eggs. Nest Eggs is a third-party administrator, open architecture record keeper, and SEC registered investment advisor under one roof, under one bundle, serving as fiduciary, serving the qualified retirement plan space. And we engage with CPAs in a very high number and collaborate to serve the needs of our clients. And for that reason, we've partnered with FICBA to present to you guys this topic of how to cut costs, create efficiency, tax efficiency, and how to armor your clients' qualified retirement plans against COVID-19. So, post-COVID, what's next? Well, let me tell you about what today is not going to be about. We are not going to talk about PPP now. I think that that horse has been beaten dead and into a pulp. Hopefully at this point you guys are subject matter experts on PPP, so long as the government doesn't reiterate or change that again last minute on the forgiveness piece. But yeah, we want to focus on today how to cut costs within the qualified retirement plan to save money and navigate all of this uncertainty. And we want to talk about 2021 and beyond, what can be done for the qualified retirement plan. And hopefully in that conversation, we shift the mindset of how you guys are looking at and engaging with your clients on their qualified retirement plans. And then we will finally talk just briefly about the opportunity to draw on personal liquidity via some of the provisions of the CARES Act. And then finally, we will bring it on home with some Q&A and hopefully answer any questions you guys have. So let's dive in. As I said, PPP is not on the topic today. We are going to now talk about what we are hearing from our clients and from our prospects and from our collaborators, what the sort of focus areas are for executives now that COVID has more or less stabilized and we're kind of navigating the future uncertainty. So there's kind of key areas in the P&L that we've been told are of high importance to try and look at to cut costs. And then there's that one comprehensive consideration of reviewing the tax plan in the firm. So first and foremost, what we're hearing from our clients, those of above average liquidity are saying, okay, let's be bullish. Let's make that investment in some capital that may reduce our human capital needs. Let's try and automate. Let's try and get some process and see if we can't free up some payroll expense. Firms of less than necessary liquidity and capital are saying, okay, we're strapped, revenue uncertainty, margin erosion, we need to do more with less. And so they are trying to optimize all their units of human capital and get sort of the most out of them to curb, again, that very large portion of the P&L, which is the payroll expense. Those very same firms that are focusing on the curbing of payroll expenses are the same ones that are also saying, you know what, we had earmarked some money to go towards capital investment this year, whether it be computers or trucks or buildings. We're going to pause that. And finally, employee benefits. So that's a broad term, and for purposes of today, I'm going to just talk about purely the qualified retirement plan, so 401k, pension, profit sharing, things like that. All right, diving right in, I want to get you guys straight to the meat of some very simple steps that can be taken by your clients to cut costs in the firm. I want to preface this, guys, with I recognize that some of these strategies that are immediate cost containment strategies for 2020 are going to have a substantial impact on larger firms, but maybe not as big of an impact on smaller firms. Nonetheless, it is an area that you could advise them towards. I'm just going to equip you with a couple quick and easy talking points so that you can go to your client and say, hey, have you looked at this? So first and foremost, depending on what type of 401k plan they have, if it's any type of tiered match, the Safe Harbor non-elective contributions, a Safe Harbor match, a QACA match, they have the ability to tinker with their eligibility. So this first ability to cut costs I'm characterizing as kind of mild. Let me back up though. I'm sure you guys all understand that with a qualified retirement plan, you have eligibility, the ability to enact eligibility requirements. And so the maximum allowable eligibility constraint that can be placed into a retirement plan is 1 year and 1,000 hours of service. So you can make a new participant wait 1 year before they can participate in your plan. Here's something interesting. If you have dual entry dates, meaning they can only enter once they become eligible, they can only enter the plan twice per year, and you stage those at January and July, then theoretically a new hire, depending on where on the calendar they were hired, could wait as much as 18 months to enter into the plan. So the first thing that your clients can do to cut costs in their qualified benefit plan is to increase the eligibility constraint that governs their plan. That means if they have immediate eligibility or monthly eligibility or quarterly or semi-annual, anything less than 1 year, they can draft an amendment increasing the eligibility constraint, notify their employees, and that can theoretically and potentially limit people who are going to come eligible into the plan this year. That can keep them out until next year. Now, of course, anyone who has satisfied eligibility requirements as they were previously written would be obligated to still come into the plan according to the old schedule, but you can tinker with that eligibility constraint, and certain firms, guys, that can really narrow. High growth firms that had a lot of people hire on, that can limit a lot of costs there. So the stronger action that can be taken across the board, your clients in their qualified retirement plans can opt to suspend or cancel any sponsor obligation or employee match that goes into the plan. Depending on the type of plan, there's a 30-day required notice for the IRS. From our chair as consultants in this space, we say always give the 30 days notice. Don't ever try to be cute with it. Don't risk getting accused of not being forthright with communication. But you can suspend or cancel any contribution into the plan that would go towards the employees with a 30-day notice. They would need to get, the business owner that is, would need to get with their provider to draft that amendment. There would have to be a 30-day period before it takes effect. So they would have to continue to give any contribution requirements that exist according to their plan design before the amendment. But otherwise, once that 30-day period is over, they now could have just washed their hands of a fairly robust employee expense going into that plan. Now, the plan can still stick around for deferrals out of paychecks where they can defer their own money into it. But do bear in mind that your key and highly compensated employees, they risk refunds if the requisite non-discrimination tests do not pass at the end of the year. So honestly, in that environment, the owner, the key executives probably should just consider stop deferring if they do suspend all of their employee matches. So we're going to get into this, but this is the big key that you should be asking your clients. Is this plan style even the right plan style for your business? We're going to touch on the likelihood that it's not in just a bit here. Next, for profit sharing plans, if it is a standalone profit sharing plan and if it is not attached to any type of safe harbor plan, and if the plan is written whereby each employee is written into their own classification, then this profit sharing plan can be used for a relatively tax efficient bonus structure. So, key employees, important people that firms who may be downsizing want to keep around, they can give a profit sharing allocation to every single member of their company, a different amount. They can pick and choose winners and losers. It can be, so long as every employee is in their own classification, which they'd have to check their governing plan documents, they can use this as a vehicle to give bonuses, not subject themselves to payroll tax. And in so doing, the employee gets this contribution into their plan, which is, of course, tax deferred from an income tax perspective as well. So considerations, if your client has a profit sharing plan, it's a big why. Why is every employee not in their own classification if they are not? And then finally, again, is this plan appropriate for the firm based on the demographics? And we'll touch on how to answer that question in just a little bit. Finally, cash balance and defined benefit pension plans. Guys, this is, we've had a ton of clients that we went to in March the minute that this all started and said, you must freeze your plan now. The reason for that is defined contribution plans just say, hey, me, the employer, I'm now obligated to give you a specified amount of money each year as a match, depending on how I write my plan and what I sign myself up for. Defined benefit plans are actually defining a future benefit. And so every single year there is an accrued liability that occurs in the plan such that come hell or high water, you owe these employees a set amount of money at retirement. And so with these plans, you can pause them and then take time to kind of watch what's going to happen to top line, what's going to happen to erosion potentially at bottom line. And once you have a more clear picture for what is going on in the firm and things have normalized to the extent that they will over the next 6, 12, 18 months, then you can opt to unfreeze the plan or you can cancel the plan. So there is a point of interest here because of that defined benefit obligation and because of the way that the financial instruments within the plans work. Even if you freeze or suspend a plan, there could still be a liability to pay into the plan in spite of no contributions necessarily accruing for the given plan year and during that time in which the plan is frozen. But depending on the number of participants, notices do need to go out to employees, warning them if a employer has an intention to cancel or suspend. And so you guys can read right there. If it's under 100 employees, they need 15 days notice. If it's over 100, they're going to need 45 days notice. Okay, so that's what you do with a commodity retirement plan in 2020 if you are looking to make that an area of cost savings in your business. Fairly straightforward. Let's talk about these commodity plans though. I'm going to touch on later in the week and go very in depth on what is wrong with the model in which qualified retirement plans get sold. We're actually going to spend quite a lot of time deep diving on the market, how it's constructed, how it's a complete and utter disservice to your clients, and how it's a complete and utter waste from a tax perspective and a net worth enhancement perspective to use these very commodity plan styles. But for high level, I'm going to try and condense some of those components of that presentation into this today, just to hopefully spur some creativity and get you guys to come onto the call later in the week. So here's the reality. We got to shift the perspective. 401k plans, pension plans, they are viewed as necessary evils. They are viewed as commodities. They are viewed as commodities both as the buyer of the product and service, as well as the service providers. So both sides, no one has any sort of rose-tinted glasses on. No one's talking about specificity, tax mitigation, net worth enhancement, or very few people are. It's irresponsible to say no one. But the market is not talking about the tax opportunity afforded a business owner in a qualified retirement plan. So as you see right there, we say the reality is it's one of the largest deductions available. Depending on a firm, it could be as big and as meaningful as 199A. It is a tool that can be leveraged for tax-deferred wealth extraction. If you guys want to get deep in the weeds and call me at the end of this presentation, I can tell you about how a qualified retirement plan, technically a cash balance pension plan, can be used to lower the book value of a firm in a successionary environment between older and younger partners, father and son, mother and daughter. These plans afford so many opportunities to be leveraged for the overall financial benefit of a business owner, but yet the commodity views them as the market views them as a commodity. So the reason that we know that, you have non-expert salespeople selling off of a pared down menu, a templated checklist, check a box for a safe harbor plan, check a box for a match plan, check a box for this type of eligibility requirement. There is almost no specific or technical nuances built into the construction of a plan, because it's an insurance brokerage driven model and churn and burn is sort of the MO. There is little to no consultation going on. The employee census, guys, the demographics of the firm, which are of paramount importance to reverse engineering a tax efficient plan, they don't even get brought up during the consultation or sales process of these large insurance brokerages. So it's a disservice to your clients if they are with a broker and some big, large insurance brokerage, that you guys are not engaged in helping them understand the tax opportunity that a well-designed plan could bring for them. So 2021 and beyond, that shifted focus, it needs to turn into a area of consultation for you guys as CPAs, right? This is a hand-in-glove topic. In fact, we partner with dozens up and down the eastern seaboard of CPA firms that more or less outsource our expertise like hand-in-glove and say, find us the tax savings that could be afforded in this qualified plan. Now let's marry that to the holistic tax strategy. So you guys are missing, if you're not doing this, an opportunity to go to your clients, I don't know, June, July, hopefully when things slow down a little bit for you guys after deadline seasons, before the September deadlines come up, and to just make this a value add to them. Get the pet on the head, the attaboy, the attagirl, for driving a conversation around the tax opportunity that their qualified plan could present, and then partnering with experts that can help you shore up those realities. So what we say, the entrepreneur takes all the risk. The business owner is there to make money. A commodity plan is a disservice to them. A plan design, well, let me back up. A plan should be designed. It should not be a template with the parameters of what's possible built out first. So that means the maximum amount of money that can be deferred for the owners at the minimum cost for the employees while still passing the requisite ERISA non-discrimination test. If a plan is designed with the outermost boundaries defined, then everything in between there is green grass, right? We can increase the employee contributions if we're an overly benevolent firm. We can decrease the employer deferral opportunities if, maybe they've got cash flow constraints in their home because they've got 3 children in out-of-state college or something like that. But if the firm demographics, if the census, that North Star that informs so much of how the Internal Revenue Code can be leveraged and navigated, if that's not used during the consultation process of creating a plan or reviewing a plan for a business owner, if that's not used, then the odds are just overwhelmingly almost guaranteed that plan is not going to drive any sort of tax utility or efficiency for that business owner. So more importantly, and this is how you guys can kind of engage in this process now, these plans, they get set and forget, right? People just throw them in and leave them, and they didn't think about their demographics up front. Now they've added a second building, 30 more employees, or 3 new partners with 50 new employees. Who knows what the growth constructs have looked like? But these plans just get put in this one-size-fits-all template, and no one's ever thinking about, is this even the right design for my company? And it's a lot more than just, I want to do a match or I want to do a safe harbor. That is not the type of consultation that I'm telling you guys is possible. So as the firms evolve, these plans should as well. And as a CPA advisor, the financial consultant, the financial light keeper for your clients, you guys have the ability to show them value in an environment where everybody is being asked by their clients, what have you done for me lately, right? The goal is to keep them from thinking they can go get the same thing from H&R Block down the street. You guys are going to provide exponentially more consultation than that, so this is an area where you can do it. Let me orient you guys to the numbers and the words that are on this screen. This is a sample firm. It's derived from a real firm, but we simplified numbers and ages and things to keep things kind of round. 50 employees, 1 owner, 4 highly compensated employees, and 45 rank and file non-highly compensated employees. Their ages average 60, 40, and 30. Their average compensations, you can see 285, 150, and 40. Total payroll in the neighborhood of $2 million. So what we serve to illustrate here, and I can't dive in on the technical nuances of how we've achieved what has been achieved, but all 6 of the yellow highlights on the far left-hand column describe more or less the high-level construct of the plan. All 3 within each type of plan, highlighted numbers you see, is the percentage to group. So if everyone will please just orient yourself to the first yellow line on the screen on the left-hand side. It says Safe Harbor 401k plus profit sharing. Drop down 2 lines and you're going to see the percentage to group. Now follow that all the way over to the right. In this example, what we're telling you here is that 38 cents on the dollar that's allocated into this plan is going to the owner. 16 cents on the dollar is going to his or her highly compensated employees, and 47% is going to the rank and file. So now that you can orient yourself on what I'm telling you, you can march fairly quickly down the 6 iterations of design that could be deployed for this firm, and you can see how dramatically more efficient some of these designs get as you wander down the page. This is the type of map building or boundary line defining that doesn't go on with these templated cookie cutter plans that are 95% of the types of plans that are out there, frankly. So with thoughtful design, leveraging a lot of nuance that, again, in my presentation later in the week, we dive into a couple of considerations that are just not often deployed in the market. They're out there for everybody to learn and know and understand, but the churn and burn nature of the market prohibits people from spending that kind of time. So it's not that we're some sort of secret gurus here. We just put the necessary time into it. But with iterative design, leveraging all of the various sort of buttons and levers at the disposal of the designing entity, you can create dramatic efficiency for a business owner. In this particular example, in the neighborhood of 92 cents on the dollar in a plan going to the owner, 8 cents on the dollar going to the employees. That is tax efficiency. And the examples that we'll be wandering through at the end of the week, and I'm checking my time here because I know this is a very quick talk. We will show not only how designing a plan and weaponizing for the benefit of the owner is the way to create tax efficiency, but then we show you the investment implications of compounded growth on these pre-tax dollars versus if the money had been taken as a sub-S distribution. So moving forward, this is something that a very, very wise person in the market, he's a gentleman that authors some textbooks for the American College of Financial Planning, has said, everybody gets mired down in the fees of a retirement plan. People call us all the time and they say, let me get a quote for a retirement plan. As if it is literally just like this chair, right? How much does your chair cost? Well, these very basic chairs here, that's how the market sells them. Sure, you can this price, this price, this price. The answer is we don't know because we don't know what kind of plan you need, and we won't know what kind of plan you need until we look at your demographics. So the consideration by this particular gentleman who wrote the curriculum for the CFP designation at the American College of Financial Planning said it's not the fees, whether service fees or expense ratio fees for a qualified retirement plan that are the most expensive part of the retirement plan. The most expensive part is the wasteful wasteful and unnecessary contributions to the employees and the forfeited tax opportunity of business owners that are caused by these very, very commodity designs. So, as the CPA advisor, again, these people trust you with all facets of their monetary life. This is an area where you guys can, it's in your lane, you can outsource the expertise, but you guys can drive referrals. You guys can drive recommendations. You guys can drive curiosity, which is some high-level talking points of, guys, do you even know that this plan matches the uniquities of your firm? Johnny, Betty, have you had the actual structure of your plan ever audited or benchmarked by someone that excels in design, or do you only ever look at the investments and the performance and the fees? Odds are they probably aren't even looking at those either. But guys, big opportunity to show value in this cost-conscious world that we're living in, where everybody is, again, saying, what have you done for me lately? Why don't I just go down the street to H&R Block? I don't think that what you do is that technical. The more value you can add, I spend 50% of my time connecting people that are completely disparate in industries unrelated to my own, because I become that maven that's in between different people, and they say, hey, I can go to this guy and I can get good recommendations, good referrals. As a CPA advisor, this is actually at least in your lane, in your general wheelhouse. You guys have the ability to advise your clients to refuse these commodity templated plan designs and to look for a more technical plan that's specifically custom to the unique demographics of the firm. So again, my name is Alex Jenkins. Very grateful to have you guys here. You can find me at any of the information listed above, alex@nestegg's401k.com. My cell phone number, morning, noon, night, 904-252-6780, and our website, 401k.com. It has been a pleasure to be with you guys, though I can't see anybody. Everybody's looking at me. We can tee it up for the Q&A now, Adam. I appreciate the time, guys. Thanks.